Okay, if we look at this week, I think the big news to me was that Europe came in weaker than expected. China's already been weaker. Everybody expects that. They over-control it, make it look smoother than it is. You know, they overstate a bit. So we know that. But Germany came in reporting retail sales declining 4.3% in December, and year over year in 2018, 2.2%. It shows that their consumer sector, which is driven by demographics, is weakening, as our demographics say that's the weakest sector in Europe, along with Italy and Greece and Portugal. And most people don't see that. More important, Italy fell into a technical recession. 2 quarters, third quarter down 0.1%, fourth quarter 0.2%. Not giant numbers, but still negative. Germany actually was worse in the last 2 quarters, but the third quarter was more negative and the fourth quarter was slightly positive, which means they escaped the technical definition of recession. But again, Europe is weakening. Our demographic indicators tell us that Germany, Austria, Italy, Greece, Portugal are the weakest parts of Europe, and Germany is the weakest going forward. So that's going to be the big surprise. And again, no surprise to us that this is happening, but it's finally hitting the news. Now, the other factor is China. Now, first of all, the stock markets were up recently because 2 things the markets have been looking for. They've been looking for the Fed to back off on raising short-term rates and selling their bonds, drawing down their balance sheet. And that happened. But it happened from Chairman Powell because the world is slowing, Europe and China. So the key today on Thursday is that we finally saw the markets start to correct. I've been looking for a correction here. We're looking for a correction that will either take this rally off the late December lows and correct 50, 60% of that rally and be part of an ongoing bull market that takes us to new highs in 2019, the dark window I've been talking about, and or we could see a steeper correction near term that retests the lows in late December or makes new lows or even more than that. But a lot of those scenarios could still be in this dark window. So that's what we're looking for now. What happened today and Thursday, coming into Friday, is that China disappointed again on the trade talks. Now, this is no surprise to us. I've been saying that China is playing hard here. This is a long-term strategic war for them, not a short-term battle. For Trump, it's a short-term battle to be hard on the Chinese and win support from his base and voters. China keeps stalling on this. It's acting like, oh, yeah, we're near a deal. But no, March 1st is coming up. Now it looks like there will not be a meeting between Trump and China. So that's the markets, okay, got what they wanted on the Fed, but the world keeps slowing, and China trade deal looks like it's put off again. So this is an important time. I'm going to be watching in the next few weeks how far does this correction go if it continues, and it looks like it probably will. I think that's going to tell us a lot, and we're going to be looking for signs of whether we get this kind of rolling bear market, which I do think is not the most likely scenario, or whether we get a correction here, whether it's new lows or not, that sets the stage for the final blow-off rally or dark window in this unbelievably overextended, quantitative easing, artificial bubble of all times. And when it crashes, it's going to be extreme. You can bet on that. And again, our indicators show that Our longer-term cycles say the last basic topping point is somewhere around late 2019, early 2020. And then we go into the worst of our long-term indicators between 2020 and 2022, maybe 2023. So that's what we're looking for. We'll keep you updated, but we're going to be watching this correction carefully to get better signs. Bull or bear in 2019, and we still favor the bullish outlook until it's proven otherwise.